Hello. In this module, we would look at the most important economic data, and that is the potential GDP. We were going to be able to answer a very simple question uh, like, is the economy growing too fast or too slow? Because if we have an idea on this question, then we will know how to anticipate whether the Federal Reserve or the central bank of any country will look to raise rate or cut rates. And related to this potential GDP is we will be able to answer the question, how come 4% growth in the US is inflationary, forcing the Fed to tighten? But 4% growth in China would be deflationary, forcing the People's Bank of China to cut rates. So in this first section, we're going to look at the introduction. Right? The deliverables will be to help you obtain a framework to analyze a country's growth and be familiar with important sources of data and investment ideas. Nowadays, there's a lot of very good information that's available on some of these websites, which I will be showing you. So as I said just now, the objective here is to be able to explain when a company is growing, when an economy is growing too fast or too slow. And know what are the factors affecting growth in a particular country. For this, we will use the CIGX approach: consumption, investment, government spending, and X for net export. Right? And we also look at the causes and impact of inflation and deflation. Right? Throughout these several modules, you will learn how to create charts from Fred and trading economics, which I highly recommend that you get very comfortable with it, right? Because when you write papers, when you have presentation, right, it's very important to justify what you say with data. And producing any charts in Fed and economics takes less than a minute. Okay. All right, so if we were to start thinking about how would we analyze a country's investment possibilities, what would we invest in? Well, this question will provide the glue that would put everything together in these few modules. Right? It's also the compass, a direction where we are heading towards, so that at the end of these classes, you can feel very confident that you can answer this question. And sometimes when we go to classes, we see and hear a lot of things, but we are not sure what we have learned. So in this case, right, these two questions would give you an idea, right, what to look up for, so that if you ask yourself or if someone asks you, what did you learn in ... Right, you can say that in this class, right, you learn how to analyze the country's investment possibilities, and you know what to invest in. Right? And very important that classes are meant to provoke thinking, provoke active learning, and it's important that you need to practice and practice and practice. Okay. A good way to practice is to keep reading the newspaper, keep reading the financial newspaper, and if possible, right, take active notes and write down. Okay, right, write down, and for every article you read, right, look at the different asset class, right? What is this article saying? Is it talking about stock, bonds, currency? What kind of data is this article referring to, right? Why do they see something like non-farm payroll and not payroll? How come the payroll number is as important as the unemployment rate? Right? What is a CPI? How is that different from the personal consumption expenditure index? Right? And the macroeconomic policies, right? You will see that monetary policy transmit in a very different way compared to currency policies. Right? Monetary policy transmit, right, through the, right, banking system. Monetary policy affect interest rate. Interest rate affect borrowers and lenders. Right? Currency policy is very different. Currency policy affect export and import. Right? A weaker currency would help exporters but hurt importers. So I encourage people to, as they learn and they want to practice, to just invest $1,000, $2,000, $10,000 into any of this trading platform, right? Nowadays, all this platform is commission free, right? By risking a small amount of money, right, you get to practice, practice, practice. Right? So let me illustrate how to dissect a particular newspaper. So for example, this Wall Street Journal article, January 22nd, 2019, it says here, US stocks open lower as economic concerns resurfaces, right? So concern around global growth have weighed on the equity market. The International Monetary Fund, the IMF, reduced its forecast for global economic growth in 2019 to 3.5% from 3.7% estimate posted earlier. So we learned two things, right? We learned that number one, that the IMF, right, is an institution that the market pay attention to, right? Number two, right, we learned that even a small amount of change from 3.7 to 3.5 is a big deal to the market. Right? And continuing on this article, right, this global economist at Fidelity said that the slowdown in China is a positive signal for the world's second largest economy and suggests Beijing isn't using unproductive big bang stimulus measure. Well, this is rather surprising, right? Because typically when we read about slowdown for country, it is not good, it's negative. But in this particular case, right, this global economist at Fidelity says that it's a good thing, right? And she mentioned something about unproductive big bang stimulus measure, right? So what are these big bang unproductive stimulus measure, right? So this keep us on our toes and make us want to read more and now with Google search, right, it's so simple to find out, right, more about certain things that the market is talking about. Right? At the end of all this, it's important to have a framework to come up with an idea, right? How you process all this information. Right? We look at international economic condition, we read about US fiscal policy, monetary policy, US economic condition, and all this understanding of economics and policies, right, help us to think about one part of the equation that affect the industry and the firms, and eventually the firm's stock price, right? Which is what we are trying to get at eventually. Okay? So when we invest, we ask ourselves, should we buy, should we sell? The one would answer is simple, yes or no, buy or sell, right? But the reason behind it is not so simple, right? So therefore, right, we need a process. And just now I show you a particular process, right? You can adopt the process or you can create your own process, but it's important to have a process, right? You don't go into a battle without a plan, right? So same thing in the market, right? You need to have a process, you need to have a plan. And we need to use the right jargon because words convey a very specific meaning, right? And words help to clarify our thinking process. Right? So that's why when you read all this financial news, right, part of the process is to collect as many of these jargons as words as possible and to figure out when to use it and what they really mean. Okay? Here is a typical example, right? What we are seeing is that this is 2018 global GDP components at market value. 173 countries outside the top 20 makes up less than a fourth of the total global economy. Right? So this is interesting. So very pie chart is very interesting, and it also helps us to think about, right, how the data are constructed. Right. For example, right, we know that in Germany, right, the GDP is calculated in euro, right, and in China, the GDP is calculated in renminbi, right? So in order to create a pie chart like this, right, the economists have to convert the Deutschmark to dollars, the renminbi to dollars, right, using the exchange rate on a particular day. Right? So when we try to answer a question like what is the largest economy in the world, we would say that it is the US, right? But this is based on market value. Right? Market value meaning that we use a exchange rate at a particular day. Right? So obviously, the exchange rate will change, right? If and when the dollar weaken sharply, like the other countries' currency strengthen, then the proportional share of the US GDP, right, to the entire world GDP would be a smaller slice. Okay, right? Well, there are other ways to look at real GDP when we compare one country with another country, right? Although it is not often used, right? But the concept of PPP is very important, right? So when we strip away the currency effect, we strip away the inflation effect, and we just focus on purchasing power parity, then the equation has changed slightly, right? And here we see that China is a lot larger than the United States, according to the PPP, right, measure of real GDP. Well, if you look at this list and I ask you, what will be in your short list for country to invest in? If you're thinking in terms of 10 years or 20 years, right? What countries would you invest in? Okay. Well, many people, right, would likely not to have a list like this, right? They would not have India and Indonesia very high on top of the list. But to the extent that if you look at the PPP of the top 10 largest countries in the world, right, by 2030, right, you have no choice but to pay serious attention to India and Indonesia, right? Because these are the countries that is going to be extremely large, right? Again, in PPP terms. And also this means that in terms of purchasing power, right, okay, their impact on the world, right, would be significant. If their impact on the world is significant, then likely that their stock market influence, right, would correspondingly move up, okay? Right? Not exactly in the same step, but in the same direction. And sometimes when we are confronted with this question, right, is country X rich? Right? It's a difficult question because a country is just a concept. A country is just a flag and national anthem and maybe a national animal, right? Okay, it's a creation, it's a concept, right? Okay, so the way I like to think about this question is to look at the per capita GDP, right? Per capita GDP based on purchasing power parity, right? Okay. So, uh, so one moment. So we can see that countries with very large population, like China, right, and Indonesia, right, they have so many people, and whatever growth they have divided by the large number of population, right, the average GDP, the per capita GDP, right, would drop significantly, right? Okay, right. Well, the United States, right, and more so UK, Germany, and Italy, right, because of the smaller population, right, the per capita GDP is a lot higher. So this has implication uh, when we are looking to sell, right, particularly consumer goods, right, to these countries. Right? We want to look at the affordability by the uh, average person, if you like, okay, average person in that country. Okay? So, so the developed countries, the United States, UK, Germany, France, Japan, Italy, right, they, the people population there have enormous like buying power, right. Well, another important aspect of jargon and understanding what we're dealing with is a very common misperception, right? For example, like, before the COVID-19 crisis, right, India is expected to be showing very high growth rate, very high growth rate, and one can visualize in a meeting where the marketing people would argue that they should devote more resources to India because India is growing at a more rapid pace, right? Okay. Well, if we dig deeper into this, right, then what we realize is that the base, right, the size of the GDP in India is a lot smaller than US, Euro area, and China. Right? What it means is that if marketing is focusing on the year-on-year increase in spending or income, right, then they should be looking at the product of the GDP growth and the base, right? So this means that using this data, that the year-on-year increase in spending or income in India is expected to be growing by $185 billion, right? Is that a lot? Well, it depends on what you're comparing against, right? But if you compare against the United States, right, you see that even though the US is expected to slow down to below 3%, right, the year-on-year increase in spending or income is more than three times the number in India, right? What about China? Well, China is 900 billion, okay, right? Even though growth is slower than India, but because the base is so large, right? The year-on-year increase is like 1.5 times that of the United States. Well, this is also why it is so difficult not to do business with China, right? Simply because now China's economy is already so large. Right? Well, this is a very interesting chart. It shows the China real GDP year-on-year change, right? How we have fallen from 11, 12%, right, all the way down to 6%, right? But if we look at the absolute, right, instead of the year-on-year change, we look at the absolute change in real GDP. Well, we see that even though we have this big drop in year-on-year growth, which is still large, this is still positive, like 6% is still positive, like 6% positive on a large base, right? You see that, right, the year-on-year change, right, okay, at about, what's this, 1.2, 1.3 trillion, 1.2, 1.3 trillion, a lot higher than the 1 to 1.1 trillion, right? Okay, back in 2012. So a bigger China's economy, right, needs less growth, right, in order to grow their total spending and and total income every year. And this concludes this section.